mutual funds are actually a very everyday phenomena. So let's talk about traveling. Yes, before getting into details of mutual funds, let's talk about something that you and me both enjoy and would understand faster. So if you were to go from Mumbai to Pune, Pune is say 3 hours away from Mumbai, which are the options that you would go for? I'm sure you would be thinking like you would take a bus, you could drive your own car. If you're a rider, you could also go for a bike. And if you're someone who loves to have the comfort, you can take your flight as well. So there are quite a few options to reach Pune from Mumbai. If you drive your own car, the first thing is that you must know how to drive. You must be focused on driving. You cannot do anything when you are going to Mumbai. You can choose your own route. So if you want to take a detour at some food joint or some other place on your way to Pune, you can do that. And you can go as per your own time, right? You can skip the traffic by going either very early or very late after an important meeting. It's completely up to you. You can plan your trip as per your convenience, provided you know how to drive and you have to fill that gas fuel. So you have to pay for the fuel. If you're someone who does not know how to drive but still want to reach Pune, then your second best option is to take a bus. Yes, here you don't drive but you rely on the driver to take you to Pune. You cannot choose your own route. So there is a designated route and a designated schedule of the bus. You have to follow that. So the plus point is that you don't have to focus on driving the way you have to do when you're taking your car. So you have to go as per the bus schedule. Here as well you have to pay, but not for fueling up the entire bus, but you have to get your bus ticket. So what are these two types of mode of transport similar to? Of course they're similar to types of investing. Yes, driving your own car is like direct investing. Whether it's in equity or in debt, when you're going and directly buying equity of various companies from the stock market, it's like driving because you have to completely focus on your investment. You have the freedom to make your own investment decisions and you can buy and sell as per your convenience. Whereas taking a bus, it is like indirect investing via mutual funds, for example. You also have other indirect investing options, which we shall discuss later in this module. So here you have outsourced the driving to an expert because you know that you either don't know how to drive or you don't want to drive. Same way, you invest in mutual funds where you don't have the expertise of either selecting that perfect stock or you don't have the time and the interest to understand the stock market of investing in individual stocks. Now, one thing to note is that mutual funds is not just about stocks. You can invest in all the asset classes. So what is direct investing? As I just said, it is like our investors, Leila, Kabir and Imran, go and buy directly from the market. They could pick up any asset class, whether it's debt product, equity, gold, and even real estate. So when they decide not to do that, but to go to a separate entity, a pass-through entity, which will be between them and the market, who will make the investment decisions for them? And these investment decisions will be made by a fund manager. So they outsource the expertise to the fund manager. So your mutual fund becomes your bus, right? And your fund manager is your driver. So they give the funds to the mutual fund and the mutual fund transfers that money into various asset classes. Those asset classes are bought and are held by the mutual fund, and as and when it grows or reduces in value, the amount is paid back to the investors after the fund manager takes his or her fees. So yes, there are charges which are payable to the fund manager when you are investing in a mutual fund. So it's not that mutual fund is free of cost. So yes, taking that bus is definitely convenient, but it is not free of cost. There are charges that you have to bear for that convenience. So let's understand what are the various players who are there in a mutual fund and how your money actually flows from one place to another. In a mutual fund, investors like you and me come together and we have a common objective, that either we want to grow our money in the next 5 years, 2 years, or we want to invest our money for long term or short term. There could be various different objectives. We come together and give our money to an expert who's called the fund manager. Now this expert picks up various financial securities and invests in them. It could be either of the 5 asset classes that we've discussed in module 1. And then over a period of time, these securities generates return in the way of interest or capital gains, and that return is either paid out to us investors in the form of dividend, or it is kept invested in the fund and the fund grows in value. And this is how the entire circle of mutual fund works. Let's understand this with the help of some numbers, so the entire concept is very clearly registered in your mind. Investors invest 10,000 rupees into the mutual fund. The fund manager keeps a fee of 50 rupees. As we said, there is a bus fee. So yes, the fund manager keeps a fee of 50 rupees, and then they decide to invest in various financial securities an amount of 9,950 rupees. From this 9,950 rupees, say over the next 1 or 2 years, grows and becomes INR 12,000. Now the gains stay in the fund. So the mutual fund's value can be 12,000 rupees until you decide to remove money from it, or you've invested in a dividend fund where you are getting dividends regularly. So this technicality of how the returns are paid out to you, we will discuss in this session in some time. So I'm sure you've understood how your money flows in a mutual fund. So your mutual fund is nothing but it's like taking that bus from Mumbai to Pune. Your bus, that specific bus that you've taken, is a mutual fund scheme. The road on which the bus is going is market. It's the marketplace from where you're buying various asset classes. So the marketplace remains the same whether you're directly investing or indirectly investing. Similarly, the road that you take to go to Pune, either you're driving your own car or riding a bus, remains the same. So the risk and various situations that your money will be faced with is the same in both the cases. So the bumpers that a bus is going to face and the bumpers along the road that the car is going to face is going to be same. Your passengers in the bus are no one but investors. Bus driver is your expert fund manager. Your bus ticket is the mutual fund fees that gets deducted from your invested amount. And RTO is nothing but SEBI, Securities and Exchange Board of India. SEBI is the regulator of all the investors and various entities in the stock market and financial market. I'm sure with this slide you would have understood how a mutual fund works. What are the various terms related to mutual